what any central bank has to be aware of is you don't want to kill the golden goose. If you're coming from a recessionary period or a market downturn, to kill off the recovery. And that's the fine line that the Reserve Bank has to tread.
Welcome to the NZ Guide to Financial Freedom podcast. It's run by the co-founders of a free online learning platform called moneyskills.co.nz, and it has the sole mission of providing every New Zealander the opportunity to live a more fulfilling life. So let's kick into it.
It's been a little while, Greg. We haven't seen you. The listeners, to put it in perspective, since lockdown began, have only listened to me give or take a couple episodes. Me.
Well, probably because we weren't allowed to work together, Ryan. We had to socially distance.
Yeah.
And it was 106 days in lockdown.
Felt
and
like
of course, after that, I was certainly busy November, December, visiting clients who I hadn't been able to see for a long period of time and doing our traditional Christmas cake deliveries. So that's an important part of the relationship building that we have within our business. It's the fact that you go and see people and deliver a present. It's only a small gift, but it's the fact that you've made that effort. And it's interesting that when you do that, you find out things that you didn't know. It might be, changes in the health of the person or the clients. It might be that there are other things happening that you wouldn't necessarily be aware of. I mean, a couple of years ago, I turned up and there was a big for sale sign on the house. So had I turned up later, they wouldn't have been there.
Yeah.
Yeah.
You also had a close call. I kind of feel like, at a certain point, I might even put a defibrillator in the car. Because I know
is that for me?
Not for you. You're still hanging in. But imagine if I have clients for another 30 years and they're in their 90s and we're doing these house visits, sometimes spontaneously, you could be the reason they're still alive.
Yeah, exactly. Waiting for that cake.
Hanging in it. Anyway, we won't go down that dark and dangerous road. But we have a question here actually from a fan. Well, a listener. I don't know what you call them.
Yeah.
Probably not fan. But hey, guys. Love the content you've been producing. Haven't heard any discussion about central banks yet, but that's probably a dry topic for most. However, considering they're the biggest player in markets right now and subject to a lot of controversy, it'd be really interesting to get your take on them and what their impacts are for society. Some questions I had were, is it debatable that they exacerbate wealth inequality, or let's say exacerbated wealth inequality by pushing up asset prices, considering only a small portion of the population owns financial assets? Who owns central banks? Japan and Switzerland are both publicly traded, but hidden benefactors behind the other central banks in the world. I am trying to read this. There's a few words there in the wrong places. There's a few questions. Hang on. Are you staying with me? Yep. Are central banks supervised by any entity, or do they rely on public trust to operate? This last point is probably more applicable to the US Fed, considering the recent revelations of trading by their members. Bit of a contentious topic, I'm sure, but that's what makes a good debate and an entertaining podcast. Thanks for producing quality content anyway, and the positive impact you're having in the world. Cheers, Sam. Thanks, Sam.
There's probably a bit of a dry topic, Ryan, but it's an important one. I mean, fundamentally, the central banks, in our case the Reserve Bank in New Zealand, are like the government. They're owned by the people. So they don't belong to a private entity. They're not publicly traded. It's basically an arm of government, but it's separated from government. So the Reserve Bank is mandated to do a number of things, particularly in respect of inflation. They're mandated to try and keep inflation between 1% and 3%. But they may be mandated to keep a level of full employment, if you like. They may be mandated to do a number of things, and that mandate comes from the government of the day. But other than that, the day-to-day activities of the bank are independent of government. So Grant Robinson doesn't ring up Adrian Orr and say, oh, by the way, Adrian, I think we should put up interest rates this week, or, oh, by the way, I think we should drop them next month. It doesn't work that way. The bank is, for all intents and purposes, independent from government, but their role is on the monetary side, not the fiscal side. It's not their role to put into place taxation arrangements, but it is their place to say, well, we're going to increase or reduce the official cash rate. And what we've seen is, in response to what the Reserve Bank see as a rise of inflation in New Zealand, we talked about 4.9 and they're thinking maybe it's up to 6%. They're looking at pushing the official cash rate from, I think it was 0.25 up to 0.5. And, it's projected to continue to go up. Interestingly enough, the same inflationary concerns are there in Australia and the US, but the response has been quite different. I suppose in some respects, what any central bank has to be aware of is you don't want to kill the golden goose. You don't want to, if you're coming from a recessionary period or a market downturn, to kill off the recovery. And that's the fine line that the Reserve Bank has to tread, because those interest rates will flow on probably to currency rates. So if investors globally can see they're going to get a higher yield in New Zealand than they will, say, in Europe, money will flow here, and vice versa. They talk about the Belgian dentist basically looking to buy New Zealand bonds if interest rates are up. But of course, that's a cost. There's a cost to the New Zealand government servicing any borrowings. So if you've got interest rates going up globally, that is a cost that government has to wear. At the moment, the government's been very lucky because they've borrowed squillions of dollars, billions of dollars, to ease the New Zealand economy through this COVID period. But the cost of borrowing has been minimal, because interest rates globally have been practically zero. But if those interest rates go up, there will be a real cost to government. But certainly our Reserve Bank seems to be on the more aggressive side. They're saying they're putting up interest rates. In Australia and the US, I understand that the expectation is that rates will go up, but not necessarily as quickly as they are in New Zealand. Of course, that official cash rate will then translate into two things. It means, as I say, first, the increase in the New Zealand dollar, and that benefits importers but penalises exporters. The other one it flows into is the mortgage rates that people have to pay. So we're seeing that the day of the low mortgage, 2% plus, is more likely to be more like 4%. So that has an effect on people's personal balance sheets, if you like, their ability to borrow and service debt. It will flow on to the property market in due course. So it's all kind of interrelated. And if exporters aren't doing well because of a high New Zealand dollar, that will flow through to the economy, and you can go from the recovery to the recession. It can flip-flop. So that's a bit of a concern. And we're lucky at the moment because we've got low unemployment. But that creates a problem because with the fact that our economy is shut down and we don't have migration, and there's not new workers coming in, a shortage of employable people might push up interest rates. Push up wages. Yeah. And, of course, that flows on to businesses who suddenly faced with higher interest costs, higher wages, not an ability to pass that on, and suddenly corporate profitability will fall, and it flows through to the share market. So it's all kind of connected. So, the Reserve Bank have to be careful that in promoting a sneeze, they don't promote a cold. So they're trying to tread a fine line.
That is a very fine line. And especially as well with supply chains, you'd think, let's say the New Zealand dollar increases in value. It means you can buy more stuff overseas, so it's better for an importer, but then it's hard to get it in. And then you've got the same in reverse for exporters trying to get it out.
Well, the cost of shipping has just gone through the roof, and that's another thing that exporters are having to face. The price of containerized shipping is probably quadrupled. And that means if you've got a lot of items in that container, there's an increase, isn't it, that you have to absorb because the international people don't care about your costs. You're selling in an open market. It's supply and demand.
So you got business owners, potentially interest rates going up, potentially wages going up, and then the supply issues. And where's the positive silver line? Is there a silver lining, something to look forward to, do you think?
Well, I think if interest rates are going up because there is a level of inflation, that tells you that there should be a recovery occurring, that people are spending and they're confident about the future. So that's the positive side of things. The negative side is the concern about where inflation will go. It's been one of those things that someone of my generation is struggling to kind of understand, because we understood in the 70s and 80s and 90s where we had relatively high inflation. I can remember when it was sort of averaging between 12 and 15%. Yes. That's a lot.
That is, that's great.
You understood then that translated into higher property prices. Okay, it translated into higher wages, which in turn were a bit inflationary. So it was the dog chasing its tail a little bit. But you could understand that, in a higher inflationary environment, leaving your money in the bank was a lose-lose game. So the smart thing was to buy assets that would grow in value. Now, they could be collectibles, but the most common asset that was perceived to be growing in value was property, because it had an income, whether it was commercial, industrial, or residential. And the one that mums and dads and people like me bought into was residential, because it was easier to understand, it was easier to manage in some respects, certainly easier from the point of view of lost a tenant to find another one, which is the big problem with commercial and industrial. You've got a tenant that if you lose, you may not be able to replace them. But with residential, you can normally replace a tenant, but you might just have to drop the rent. And I've been through that situation, but it was always possible to get an income stream. And then it was about servicing that income stream from the rental income, which was always negative, if you like. These properties were always negatively geared, more money going out than coming in, but you could offset the losses against your other income and reduce your tax bill. And in the early days, back in the 70s, tax rates in 80s were up to 66% in the top income earner. So it was a very attractive proposition for people. So I understood that. But look what we've seen over the last probably 10 years. Very low inflation, low interest rates, rents have gone up, and property prices have gone through the roof. I understand rents going up because of property prices being higher. Landlords need to get a return on their money. They might not be paying much in interest, but they're having to borrow a lot of money. If you were borrowing, bought $1 million property, which starts to be the norm, it's bizarre. $1 million property, or 8 to 100,000 is an entry-level property, and you were having to borrow 600,000, maybe 700,000, maybe 750,000, and interest rates are 2% at 750,000. Well, that's not much. It's 15,000, isn't it? It's sort of 1,250 a month. But what if interest rates double?
Yeah.
And go from 2% to 4%? Now you're having to pay back 2,500 a month, just on interest only. And the bank has this funny habit of wanting to get its money back, so they'll start charging principal as well. And you go, well, it's only 4%. What if it doubles again?
Yeah.
To 8? Well, suddenly that 30 is 60. That's $5,000 a month, and suddenly you're in big trouble. You need two incomes to fund it, and suddenly, the economy eases or whatever, and you can only have one member of the family employed. Then we run into the situation where we'll see mortgagee sales.
Sad.
We'll see property prices coming back. And, that's good for some people, good for first home buyers, not so good for people who have borrowed heavily to buy a home for investment or otherwise. And of course, it worries the retired generation who are looking at the equity in their home as a way of possibly funding their retirement. And of course, there's always that other generation, the ones expecting to inherit, looking very warily at mum and dad's house, and they don't want to see that go down, because when mum and dad kick the bucket, they want that money to fund their retirement.
Yeah.
Which was not actually, when I think of my parents, in the expectation of my parents, because their parents didn't own property. And, when my parents departed this mortal coil, their property wasn't worth a truckload of money. But my generation, the properties are worth a truckload of money. So our kids are possibly looking at that property and thinking, hope mum and dad don't live too long.
It does get cold like that.
Yeah.
Anyways, but I think really the summary, as you were saying, is the central banks, there's a degree of separation. It's not to say every single country is perfectly well run and uncorrupt, but there's a certain level of degree of separation to make sure that they do make impartial decisions. Whether they do all the time, it seems like they're doing the best they can, and it's a tough job. But any closing remarks you'd want that people are hearing the doom and gloom, even from Mr. Moyle?
No, it's never doom or gloom. I mean, we're living in a period, they talk about the new normal. Yeah. And, markets have been very volatile and will probably continue to be that. But, people who have got a plan for the future, a plan that tells them where the money will come from when they're no longer in paid employment, thinking about how much they need and how long they're going to live for without that income, can start juggling the numbers to think about where the money should be positioned. Ultimately, there are only 4 places you can invest: cash, bonds, property and equities. Yeah, there's lots of derivatives off there, and the cryptocurrencies and all the other interesting stuff. But it all comes down to cash, bonds, property and equities businesses. Yeah. And, the business might be your own business, but that's a risk, because you may not have someone who will buy that business at a price that you want. So for those of our clients who we use managed funds as a way of investing, there's a lot more diversification. They get much better quality assets, and most of all, they get liquidity. So they can actually, liquidate some or all of their assets to fund their future requirements. So irrespective of what comes up, there's always a winner and a loser. If interest rates go up, cash becomes a lot more attractive. Bonds less so in the short term. If interest rates are going up because of inflation, that means probably that property will do well. It probably means that companies will do well because the economy is doing well. You don't get inflation in a growing, in a retreating economy. When we're in a recession, inflation's not a problem.
No.
Inflation's a problem for people who aren't properly prepared or geared or organised for it. So if you're sitting in retirement with your money in cash or term deposits, inflation is like a cancer for you. It will bite you in the bum, because you will go through your capital much quicker than you would otherwise. So you need a lot more of it. And basically every year you're going backwards. Not only in terms of reducing your capital, but it's the purchasing power of that capital that goes backwards.
Yeah.
But I'm very optimistic. I think it's very easy to be pessimistic when we've gone through the last couple of years, but there will be winners and losers in different businesses and industries and economies, and that's why having a proper spread, having professional management, understanding that the numbers, basically, you can't fund a decent lifestyle in retirement if you've got $10,000 and that's it. you're going to need a lot more than $10,000. You may need a lot more than $100,000. But it depends on what age you stop paid employment.
True.
Perhaps you should never stop.
Yeah, that's the one way around it. Well, I think that's the benefit of why we approach things the way we do, thinking about insurance structure, having an emergency fund, making sure you insure both parties, and you're also planning conservatively because unexpected things happen. So thanks for your valuable time on the podcast, mate. And if anyone actually, appreciated it, could give us a review. It's how more people listen to it, because you wouldn't listen to us go into a restaurant that no one's in there unless you're a pioneer. So yeah, thanks. And thanks for listening.
My pleasure.